The CPI inflation data has just crossed, and Gurpreet, we were expecting it to tick up. It's ticked up more than expected.
More than expected. We were expecting it to come in at 2.8% for January, but it's come in at 3%, so higher than we were expecting, and up from 2.5% in December. Crucially, above the Bank of England's 2% target. It was already worried about what to do with inflation, considering that the economic outlook isn't looking great. And all of this suggests that we just can't get complacent on inflation. More specifically, the Bank of England can't get complacent on inflation. But it is in a bit of a tight spot because, as I said, although inflation is above target and it's expected to go even further above target, the Bank of England sees it hitting 3.3% later in the year on the back of rising energy bills. The economy is struggling. Although we had a bit of a surprise on GDP recently, it's very much stagnating, and that means the Bank of England's in a bit of a bind, because on the one hand you would expect interest rates to stay high to bring inflation down to target, but that also risks sucking even more steam out of the economy. And at the moment the Bank of England is trying to weigh those two up, and in fact we had two rate setters recently who voted for a chunky quarter percentage point cut in interest rates to try and shore up the economy. But all of this is a reminder of the inflationary risks that do persist in the economy. One of the big ones is wage growth. Recently, we had data on wage growth, which showed us that wages are rising at their fastest pace in 3 years in real terms towards the end of the year. The fear is higher wages drive up inflation even higher. So all of this is stuff that the Bank of England's going to have to now weigh up.
Yeah, and just to remind some of the key numbers that crossed in this, it was 2.5% in December. It was expected to rise to 2.8%, but went to 3%. That is CPI. If we just dwell on a couple of the subsectors of that, core CPI, when you strip out energy and food, was 3.7%. That is as expected. And service inflation, which is often focused on as an important and sticky subsector inflation, was 5%. That's risen from 4.4% in December. Some had expected it to rise a little bit more. Gurpreet, it speaks, as you were saying, to the extent to which inflation is sticky. It doesn't go away quickly, and it is in fact rising for this month at least. Just remind us where the Bank of England is, because they cut rates at the start of the month from 4.75 to 4.5%. We hadn't expected a cut again as soon as next month. So there's probably no change, at least to the market expectations around that.
Yeah, market expectations. So this is investors in the financial markets. They place bets on where they think the Bank of England's going to go. They're very much of the view that the bank's not going to cut interest rates on the back of some of that weak economic data we've been seeing. In fact, 74% said the bank's not going to cut interest rates. And now we've had this inflation data, 3% above target. We'll have to see how the markets move, but it's very unlikely now that the bank is going to move on that.
Yeah, so unlikely to get another cut, certainly in the short term. Mari, we talked about this earlier. Is it a political headache? Is it a bad headline? It's 1 month's data, and we're not talking about a return to the huge levels from a couple of years ago. And importantly, as Gurpreet was saying, wage growth is higher, so people should at least not be feeling the pinch too much. But it does start with a 3. We cut at straws on this, but that is a significant step up again, away from the bank's target of 2%.
I think it is. And I think politically, again, when it comes to the politics of this, it's about how things look and it's about how people feel. And so I think that 3% number, first of all, is just so much further from that target than we were before. Also, let's not forget that when Labour were in opposition, the amount of times inflation figures would come out, and when it was creeping up, even when it was back under control, and it was creeping up, they would be the first out there to say, look at what the Conservatives are doing, this is their fault, they've lost control of the economy. And now they are obviously in power, they're starting to realise that actually this stuff is really tricky and you will be blamed for it, even if you believe it's not your fault or there are external factors that are affecting it, for instance. And so I think Rachel Reeves now has a job where, as Gurpreet was pointing out, the GDP figures were a bit of a pleasant surprise. The unemployment figures not ticking up yesterday would have been a nice little bonus, as it were. But now things are going in a different direction. And so I think, politically speaking, Rachel Reeves is going to be looking at those numbers and thinking, OK, I need to change the optics on this.
We're going to be hearing from the government a little bit later, Dame Diana Johnson, in 10 minutes. We've also just got a statement from Rachel Reeves saying, getting more money in people's pockets is my #1 mission. Since the election, we've seen a year-on-year wage after inflation's growing at their fastest rate. But I know that millions of families are still struggling. That's why we're going further and faster to deliver economic growth by taking on the blockers to get Britain building again. And goes on to say, aiming to secure well-paid jobs and get more pounds in the pockets. That statement could have been written yesterday or a month ago.
Probably was.
Probably was. Nothing that actually relates to the new data, other than the fact that we learnt yesterday, not today, as we mentioned, that wage growth is higher than inflation. So in terms of those people in those jobs, they are getting a real increase in their wages, even though this inflation has picked up. Guys, we have to leave it there. We're going to talk more about inflation. Simon French will be joining us later. As I said, the government, Dame Diana Johnson, joining us in about 10 minutes. Gurpreet Mari, thank you so much for now.